What the heck is a 1031 exchange? The original 1031 exchange was legislated into law with the Revenue Act of 1921. There have been changes since then with time limits. The 1031 exchange, also known as a like-kind exchange, is a strategic play in the real estate game. It allows investors to reinvest profits from a property sale into another property, effectively deferring all capital gain taxes. Think of it as a legal shortcut to keeping more of your investment earnings in your pocket. Confused already? Don't worry, we'll break it down for you. First off, you need to sell a property. This isn't just any property, mind you, it has to be an investment or business property. You can't sell your personal residence and expect to benefit from a 1031 exchange. So first step, sell that investment property. Now once you've sold your property, the clock starts ticking. You have precisely 45 days to identify potential replacement properties. This is known as the identification period. It's not as easy as you might think. There are specific rules about what qualifies as a like-kind property. Generally speaking, it means any other type of investment property in the United States. It could be an apartment building, a commercial office, land, or even a rental home. But remember, it must be like-kind. You do not have to buy the property that you identified. However, do not identify a property within this period if you don't plan to buy it. Otherwise, the money is locked in until the 180 days are up. You might be wondering, can I identify more than one property? The answer is yes. The IRS gives you 3 options. You can identify up to 3 properties regardless of their market values, or you can identify any number of properties as long as their combined value doesn't exceed 200% of the value of the property sold. There's also a 95% rule, but that's a bit more complicated. Now, the third step is to buy the identified property, and you have exactly 180 days from the day you sold your property to close on the replacement property. This is known as the exchange period. The clock is always ticking, so you need to act fast. Throughout this process, you need a qualified intermediary. This is a neutral third party who holds on to the proceeds from the sale of your property. They're the ones who buy the replacement property on your behalf using these funds. They can't be your friend, family, or anyone you've worked with in the past 2 years, so choose wisely. Sounds simple enough, right? But let's remember, the devil is in the details. So what do you really need to grasp about 1031 exchanges? Here's a quick rundown. First, remember the strict time limits: 45 days to identify a replacement property and 180 days to close the deal. Second, the replacement property must be like-kind, similar in nature or character. Finally, you'll need a qualified intermediary to handle the exchange. They're the glue holding this process together. You must have a signed agreement with your chosen intermediary before signing the closing documents. The proceeds will go to this intermediary. And there you have it, a 1031 exchange demystified. Remember, knowledge is power, especially when it comes to taxes.